Hello, everybody. I'm Daryl. We're just going to wait a few more minutes here to see if we can get everybody on that wanted to come check this out. So we'll give a few more minutes for folks to pop on here. This is my first time doing a live, so this will be an interesting learning experience and test. So if you have any feedback, please, I'd love to hear it. All right, we'll give it about 2 or 3 more minutes here, and then we'll start up. Hopefully everybody can see my screen okay. All right, we'll go ahead and get started. So, tell you a little bit about myself and why I'm even doing this webinar is, I'm a financial professional and I come from a family history of struggling with finances, living paycheck to paycheck most of our lives and really just not knowing what to do with money or how to deal with it. And what I found was what I had in childhood, I ended up bringing into my adult life and struggling with it there too, not knowing how to deal with it. And so, I had different ideas. I read different things about, stay out of debt, do these different things, and this will help. And so I looked at a lot of those things, but it took me a while to really understand how to structure things in a way to actually save. And so one of the things that was a struggle is trying to find that those surplus dollars to be able to save. And one of the biggest reasons why I find that families and business owners don't save is because Parkinson's law says that basically you use up whatever's available. And so if the money's not set aside up front, then there tends to be a lack of savings. And you see this actually work well with 401ks and IRAs, right? If they're set up with their work, oftentimes the fact that it comes out of your paycheck before you even know it or you realize it, then you don't spend it, right? The downside to that, and it's not all downside, is that you can't use it, right? And so it's great to be saving, but it's really hard to save when you can't use the money for the things that you need in life. And so one of the things that I love about this concept is not that you take away the IRA, the 401k, or whatever else, the Roth that you're doing. It's that you look at the money you're already spending. It's easy to come and say, okay, I think I have this much surplus, and so I'll save that. But what if we could take and look at the money that you're already spending? And so that would be a game changer for me. And with this concept, you can actually take and a mortgage expenses, whatever it might be, and you can actually take that, funnel it through this system, and without paying a dollar extra more than you're paying as far as your mortgage or your expenses go, you could actually be saving that same amount. And I know it sounds a little bit crazy, like how could you do that? But it's really not complicated, and I'll show you the math of it actually and the steps to that process. And please, reach out if you have any questions or anything on this as we go through it. I'd love to see comments and feedback, and if it doesn't make sense to you, I welcome it for sure. I'm always in a learning process with this. So anyway, what I'm going to refer to as your private banking policy is really a whole life policy structured specifically for the purpose of high cash growth with a mutual company that pays dividends. So I'm going to use that term as a banking. So it's not a bank, very important. It's not a bank, right? But it's the banking concept and how you use this policy. And it might seem like, it's life insurance. It's for a death benefit. That's all that matters with it. Well, really, you can use it for lots of things. A death benefit's just very important to protect your family or the ones that you leave behind, right? There's a lot of other things that you can use it for, and I'm going to show you that today. So with this process, we can actually take your expenses, and I'll give an example of a mortgage specifically at the end of this, and say, okay, what if we could save that mortgage? What if we could save the equivalent? Can you imagine your mortgage is just say $2,000, for instance? What if you could save $2,000 a month? Well, right now, I bet you it's hard to do that if you don't have that cash flow free after all your expenses are paid and you go out to eat and you do all the things that you do, right? But what if we could do that with the mortgage expense? And so how we're going to do that is through a 5-step process. First step is we're going to fund this private banking policy, which is a whole life insurance policy specifically structured for this purpose. We're going to create a reserve buffer, much like you have in your checking account, right? You don't want to leave your checking account to zero at the end of every month, right? When you pay your bills, because then you have nothing as a buffer. So what you try and do is keep some, a few thousand, 10,000, whatever it is, 5,000, doesn't matter. It's every situation's different in that checking account. So that way, when you go from month to month and you have income coming in and expenses going out, you're able to actually have a buffer there so that you never actually hit zero, right? Well, you do the same thing with this. And so there's a little bit of a jump start period. And what you do is you just move some money from a bank account into the policy as what we call a lump sum or a jump start. And that actually kind of gets that buffer in there. So now we have a little bit of a buffer, and the money's going to continue to grow. We're not spending, we're not using it up, but we're going to have to not use that jump start amount for just a few months usually to get ahead of it. And hopefully that's what it was doing in your checking account anyway, right? And maybe you just take a portion of that for this buffer. We work all that out in the details. And we do that. We fund the policy and we get everything set up. And then we immediately, within literally 15 days or less, we take a policy loan from the policy and we use that to actually pay our expenses. And I like to do this on a quarterly basis because it simplifies it a little bit. You could technically do it monthly, but quarterly works a lot better in my opinion. And so let's say the first quarter you jumpstart this policy, right? You get the money in there, and now you're ready to say, I got to pay my mortgage for the next 3 months. We'll use that as an example. Could be car payments, could be all of your expenses, whatever you want to do. I've done my whole quarterly expenses on this method. And so you take that as a policy loan. Now, if you take it as a policy loan, it's not like the bank account where you took your money out and it's no longer available. It's actually in there working, earning interest and dividends while it's in there still, even though you removed it to pay your expenses. That's one of the unique things about this, right? Your money can grow while you use it. That's very important. And so now we go ahead and we take the money in policy loan. You go online to a portal. Usually it takes you 30, 40 seconds to do it. Normally the money's in your bank account within 3 to 5 days. Just depends. Sometimes it can be as long as 7 if it's on the weekend. And now that money pops up into your checking account. And you go, okay, what are my bills for 3 months? What's my mortgage for 3 months, right? And go ahead and then make that payment. Now you might be able to make 3 mortgage payments at once to your mortgage. You may not. And so you just have it in there as each month you'll send it to the mortgage company, right? But now you've got that cash flow that you normally would have had every month that you pay your bills with, right? So you put in 6 plus your buffer amount, right? But let's talk about the 6. Let's say it's 6,000 if it's a $2,000 mortgage. You put that in there, and now you pull it right back out, right? So you have kind of a net zero right now. You take that, you send it to the expenses, right? Now, what do you do with that money that comes in every month that you normally would pay your bills with? Your mortgage, for instance. Well, you take that and you pay your policy loan back. And when you do that process over those 3 months, now you have all the money that you had spent on those bills back into your policy and ready for the next month. And you do it again. And you have to be really disciplined with this for this to work properly. But it's really simple. We're talking about an extra 10 minutes and a few extra steps that can make a huge difference, as we'll see. And I'm going to show you the actual mechanics of this in a spreadsheet to make it really easy. But that's the basics of it. It's not complicated. This simple math, if you think about it. So like I said, let's say you have a $2,000 a month mortgage. You're going to do this quarterly, and you've got $4,000 in your bank account as a reserve, plus you have the money you're going to use for your mortgage, right? And in this case, they had that $6,000 ready to be used for the next 3 months. They had a little bit of savings built up. Not everybody will have that, and we can adjust and work with that. We might have to build this for a few months to get it ready. But in many cases, if you have a little bit of an emergency fund, this is a great tool. And so now you take that 6,000, as we said before, you pay it to the insurance company. That becomes then a part of your policy. It starts to grow and earn interest and dividends for the rest of your life, right? You take a policy loan, so 6,000 comes back to you, so net zero, right? And then you repay it each month. $2,000 goes back, in this case of a mortgage, and refills the policy, right? So that we're ready to do it again in the next 3 months. And so if you were to do this over a 30-year period, you changed one step in the process, and you just moved the money a different way. You didn't spend any more dollars. You're actually going to gain dollars, right? If you did this over a 30-year mortgage at $2,000 a month, you could have theoretically, if all goes well, right? And these policies are based on, long-standing dividend records. If matter of fact, most of these companies have paid dividends for over 120 years, and in some cases 160 years. And so they haven't missed one in that time. They're amazing that way, financially strong through, the Great Depression, through many, world wars, things like that. And so you could have theoretically right around 1.2 million. This isn't based on stock market. It's not based on the potential growth of the interest rate market, right? It has some effect on it, but as a whole, these projections that they give are very conservative. It's not like, if the stock market produces 12% every year for 30 years, this is what you'll have. And it's not counting any down years or anything like that. This is totally different. It's a very conservative projection. And not only is it 1.2 million, but it's tax advantaged. In other words, it grows tax deferred and it can be accessed tax free under current tax law. Okay? Without spending any more than you normally would or taking on any additional risk. This is applicable to any expense in your life or business. You can do this with a business. Let's say you got $20,000 a quarter in business expenses. You can do it with this. We would structure it for that purpose. Now think about this. Not only do you have a growing savings, and I'll show you that in the spreadsheet, which you'll see as it grows, but you also have the potential to utilize this money later in retirement in your distribution phase. If you want to take income, you can actually take about $47,000 out of this particular type of policy and set up this way in tax-free income under current tax law from age 66 to 101. And you'd still have a little bit of death benefit by the end of that time to pass on to your family at the end at 101 years old. And so this income does not affect your Social Security taxation if used correctly, right? And it can be tax-free if used correctly. And so we show you how to do all of that. And so that's the basic premise. And you're saying, wait, I didn't spend any more. I didn't take on any more risk, but yet I'm able to save the equivalent of 1.2 million. That seems far-fetched, but it really isn't. It's a simple mathematical process and a very unique financial tool. And so now I'm going to share a different screen here. So give me 1 second here. I'll stop the share and I'll share my spreadsheet for you. And I think this will make a lot of sense because I'm a spreadsheet guy and it makes sense when I look at it. I'm going to get rid of my image there so that way it doesn't block the spreadsheet. All right, so if we're looking at this, right, and I know it's a lot of numbers, and this is hypothetical example, right, based on an average client situation with a 2,000-month mortgage. Every situation is going to be different, and the concept, though, remains the same. Okay, it's really important. And so if you look at this spreadsheet, we can see on a quarterly basis how this actually looks. So like I told you, we take that buffer of 4,000 in this particular scenario, plus the 6,000. That's going to be used to fund our policy that we're already sending to our bills, right? And we're going to have an available amount of about 7,000 immediately liquid, roughly. And then we're going to be able to take that, do a loan of 6,000 right there to go ahead and pay those bills. And then we're going to repay ourselves over those 3 months of that quarter, each month, our mortgage payment in this case, $2,000. And so by the end of the 3 months, we've paid ourselves back $6,000, right? And so how much have we spent during that time? We've spent $6,000 right now. Yeah, we have that buffer of 4,000. Remember, we're not going to spend that, right? That's in there as a buffer, and you'll see it come back, and it'll grow. And so then I look over here, and we're going to say, okay, at the end of that, we still have our 7,000, right? We had 7,000. We took out 6. We put 6 back, and we have 7,000 now. We have a death benefit of about $396 right there. Think about that. You've got life insurance, and you didn't pay $1 more than what you normally would have paid. Yes, there's going to be interest on a policy loan. Of course, the insurance company's not doing this for free, right? But the growth of the policy, including the amount that you're using to pay your bills, is growing at a higher pace than the interest that you're paying in most cases. I would say 95% of the cases. You have to do a really big policy loan on a large lump sum policy for that to not be the case. Not the concept we're talking about here. And if we did, we'd have the company that we could do that with. And so as you can see, we don't just end up this way at the second quarter, 7,000. We do the same exact thing. We take 6,000, put it in, right? Because that's what we're going to pay our bills with. And now we're going to do the same thing, except now we've got the initial amount we had plus some more, and now we got 10,400. We're going to do a loan to pay all our bills because we put 6 in. We're going to take 6 out to pay the bills, and then each month we're going to pay ourselves back 2,000 a month, totaling $6,000. And now we have a total of 10,400 in our policy cash value, which is in our control. We can do whatever we want with that, right? We have control of that money. Our death benefit's going to grow a little bit. I just showed only every fourth year on that. And so as you can see, we do this at the end of the first year in our fourth quarter. We've done this 4 times, right? We put 6 in. Now we're up to about 17,200. But this end of the year, we get a dividend, and most companies pay a dividend in the first year. Not all, but most of the companies we work with. And we're going to do, again, the same thing in that last fourth quarter. We're going to take out 6. We're going to put 6 back in. We paid our bills. We have a net cost of $6,000 that month, just like we would if we never did this and you never met me, right? We're going to also pay the loan interest over this time, which is calculated on a daily basis, and it'll average about this amount probably at the current interest rate. So I just did the rough math on that. And then we're going to have some growth in that policy and increase in liquidity. The policy is guaranteed to grow every single day contractually. That's the amazing thing. And it gets better every year. Nelson Nash, who kind of came up with the concept of infinite banking, he actually explained it as an airplane. When an airplane takes off, it has a full tank of gas, right? But it has enough power in those engines to take that plane at a certain speed with a full tank of gas. But every mile it flies, the gas tank empties and it becomes more efficient. And you can't stop it from becoming more efficient. It's just going to get more efficient because it has less weight, right? In the same way, these policies do the same thing. And so this first year, we've got a mixture of, I'll call it the mixture of this guaranteed growth plus an increase in liquidity because you get more liquid every year in these policies. And now, by the end of the first year, we've paid in 6,000 every month. We've got 4,000 as a buffer, which, by the way, is there. You can see it, right? We haven't spent that. And we didn't spend $1 more than we normally would, but yet we have saved in our savings here of 21,000 after they've given us a dividend and some growth and some liquidity increase. We've got $21,485. We have a death benefit now of $441,000. And every year, that's the beauty of these policies. The death benefit increases because of what's called paid up additional insurance that we're purchasing with our dividends. It's a lot more to that, but on a surface layer, the normal life insurance, you buy a face amount of 100,000 and you have 100,000 for 20 years, or whatever the term length is, right? But with this particular type of whole life, you actually have an increasing death benefit, which is great when you consider inflation, right? So as we can see, we then duplicate this and we go out to year 2, end of the fourth quarter. We've just been doing the same thing. We haven't spent any more money. We haven't taken on any additional risk. We start off that year and we've got about 32,000 now in our cash value. We pick up a dividend that year of about $2,882. We do our normal 6,000 in, 6,000 out. We pay that interest, right? Over time, that calculates it. And then we have, this year, you get a little extra boost, just has to do with the lump sum and everything, how it fits together, of our liquidity plus our guaranteed growth. And it will become more steady down here. And now we're up to 42,000. So by the end of year 2, we've got 42,000 approximately. If the dividend's around this, right, and everything looks the same, we're going to have about $42,000 in here. And usually they're within a 5% the max difference on these from their projections. So insurance companies are really good about these projections. And we've got a $480,000 death benefit. We haven't changed anything, but now we have saved a good chunk of the money we've been spending on our mortgage. And once again, we have not spent another dollar over what we were spending already. We were paying $6,000 a quarter for bills, and we are still paying $6,000 a quarter. But the difference is we now have this money funneling through this life insurance policy, and it's being saved and built up, and it can be used for all kinds of things. And so you see this process just continues. And I just went out to year 5 here on the per quarter basis. And you can see in year 5 that end of that year, that dividend is pretty nice. A projected dividend about $5,300. By the way, interest rates are on the rise, and Lafayette, one of the insurance companies, has already announced an increase in that dividend. Usually with interest rates rising, you'll see an increase in the dividend, which is going to be typically even above the projections because they were based on a low interest rate environment. So they're not guaranteed. Once again, they've paid them every year for 120 to 160 years, depending on the company we're talking about. Never missed a year in that. Pretty amazing. We had in this particular year about $6,912 in increase in the guaranteed growth plus the liquidity side. And we've got now $113,000, almost $114,000 sitting in our savings, and we didn't spend another dollar. Think about that in savings. How hard is it to save that much money from your extra surplus? It's very difficult, right? For a lot of families, a lot of business owners, because everybody else gets paid first. But what we're doing is we're forcing to pay ourselves first so that we can build up this savings. We have this unique financial tool. I don't know of any other financial tool that can do this besides these type of whole life policies. And it has to be very specifically designed for this, right? We have a death benefit now in the end of year 5 of $604,000. Amazing, right? We go down to year 10, and I just gave a snapshot of these years, right? In year 10, we're up to $260,000 in cash value. 10 years of doing this, all we did was pay our mortgage. We did a few steps in the process to make this happen. We didn't spend any more. And we accumulated $260,000 approximately in that savings. Our death benefit's now up to $832,000. And it goes on and down. Now, 30 years, as I told you before, we're up to $1.2 million. Now imagine if you did this with all of your expenses. Is that possible? It absolutely is. We might have to work up to that, but it definitely is possible. And I can work with you to go over those details and see what we can accomplish with that. Sometimes it's good to start with something simple like a mortgage, right? But like I said, I've actually done this with my quarterly expenses, and it's very easy to do. I would literally calculate what my quarterly expenses were for a quarter. I would take a policy loan for that amount. I would put that in my account to pay all my expenses. And then when my paychecks came in and my business money revenue came in, I would then take and pay back my policy loan each month, just like I was paying my bills. If I have $3,000 worth of bills a month, that's what, $9,000 a quarter, right? So imagine you can do a $9,000. This is at $6,000 a quarter, right? A business owner, $20,000 a quarter if they were doing that, and they're not spending any more than they already were. They're not taking on any more risk, right? They literally are paying the same exact amount of money they would if they never met me or never set one of these up. And so that's the concept. It's very simple, right? It's mathematically sound. The companies are solid and have that reputation of over 100 years of solid financials, right? A unique situation in the U.S., really. And so it can be done. I'm glad to walk you through your specific situation. Everything's going to be different in your situation. We can scale this down or scale it up depending on where you're at and what you want to do. But I'd love to help. If I can answer any questions, please, I welcome any feedback. Thanks so much for your time.